There was a framework shift in 2020. Obviously, COVID-19 was a major tailwind, obviously a terrible scenario in so many respects. And so there was this shift from analog to digital in almost every sector, every business, as we all know, especially in finance, in banking. We are extremely proficient in mobile-first technology, banking, acquiring people through paid channels and all the rest of it. And of course, we've seen a whole bunch of people join us on this journey towards the end of last year, but we were already there ready to go. And we built trust with our customers. The majority of our members are people who, are left out from the banking industry. There's 130 odd million people that don't fit the business model of banking at the moment. They don't have enough deposits. They don't have assets of which banks could focus on them. And so this enables us to step in with technology as a US financial technology company to bank people that are still in the process of accumulating assets. And so that's very special. Why is that? Because we're able to then step up and step into a role, one of trust when there's times of flux. So in 2020 with COVID-19, we saw many times where there was governmental opaqueness around, say, the stimulus checks, getting people's money in their bank accounts as soon as they can, unemployment benefits, things like this. And we really stepped up as a team, as a company, to really fill that void.
So is that, Stuart, is that what distinguishes you from some of these other fast-growing, highly valued fintech companies? We've covered Stripe and Plaid and some of the public ones like Square. Is it that you're going for a different income level?
Yeah, I think that's primarily right. We're actually focused on part of the market that the banks are not. And they're not actually capable of doing unless they actually change their business model. So that's like the main overarching contender challenger bank play. Compared to other challenger banks, we focus on accessibility. Over 50% of people who come and join Current as a member never had a bank account before. We have two products, multi-product strategy. One is a team bank account, one is a full checking account, which differs from many of our competitors. And then we focus on liquidity. If you're not in the banking system as traditionally thought of in the mass affluence, you don't have a credit score, you're not part of the credit cycle. And so liquidity, getting your money in your hands as soon as you can, as soon as is humanly possible, is what we're all about. And so that's another reason why we've seen such epic growth. And then finally, in value and progress, we give as much value back. We have a point system. If you think about it, when in mass affluence, you have a credit card, you get all these points, you pay all this money, and you're just used to it. But if you're on debit card rails, you're living paycheck to paycheck, you have never been afforded loyalty. No one has ever said, hey, we value your business. And we do that with gas stations and fast food. So we're really proud of the progress we've made, the accessibility, liquidity, and value we give back to the majority of Americans.
Stuart, in his recent annual letter, Jamie Dimon, in a more kind of general way, did raise the question as to why big banks are so heavily regulated, whereas fintech and other tech challenges to the financial space perhaps aren't as tightly regulated. Do you think that's a fair summation? And is your response something to say, yeah, we're getting away with this luckily, or in fact the big banks are missing a trick, not kind of investing in smaller startups like yourselves? Because I guess you are semi-regulated, but it's via a partner bank as opposed to it being yourselves.
Yeah, it's a good question. I get this one a little bit. I mean, Jamie Dimon is, the preeminent, the most talented banker of our generation. There's no doubt about that. However, it's a little disingenuous in some of those comments because, banks accumulate assets and lend money out. And if you don't fit that business model, of which Chase and many other bulge bracket banks are, they're focused on people who have, assets. And as we bifurcate society and the economy, they're just going to bank richer and richer people. That's where they're going. And of course, we are regulated by those issuing banks. We have 3 issuing bank partnerships, of which we're audited several times, from Visa to FDIC to even the Fed as well. And so we're under the exact same remit, the exact same banking regulations as Jamie Dimon and his team. So I think, under the Durbin Act from 2008, and what they were trying to do was they were trying to get to this point where small banks, community banks, would still bank people that the bulge bracket banks wouldn't do. Now, unintended consequences are that didn't really work out for the community and the regional banks, but it did work out, and it's still the same objective that was completed by that act. So I think a little disingenuous from Mr. Dimon there.
Shepard Smith here. Thanks for watching CNBC on YouTube.